If in your world, saving $700 a month now in your payment would be really advantageous to you, then maybe you should do that. But you have to keep in mind that the likelihood is that your term is going to be extended by another 30 years. Hey everyone, Travis Spear from Pine Financial Group, where we work together so you succeed. Thanks for joining us on this Friday video, and please be sure to subscribe if you're checking us out on YouTube, and if you're seeing this on Facebook, leave a comment below and let's have a conversation, or share this video for your sphere to benefit from the content we're putting out every week. Today, we're going to talk about whether or not you should refinance your properties. You're probably hearing on the radio, like I am, that we have record low rates and mortgage rates right now. And we're hearing, people are saving $700, $1,000, $1,200 a month. I'd like to dig into that just a little bit and see if it makes sense for you to do a refinance on a property, primary or rental property. So let's talk rates. Rates are at record lows or darn near, and have been for a little bit now. You hear on the radio, rates are sub 3%, and sometimes what they're leaving out is the cost to get there. So let's talk primary for just a minute. Does it make sense to refinance your primary residence right now? Well, I'd say that if your rate is probably above 4%, maybe 3.5% or 4%, it's probably worth the conversation, but there's some other caveats to consider, which we'll get into. Same in the investment world. The rates are going to be a tad higher on investment properties. So I'd say if your rate was probably above about 5.5% on investment property, it might make sense to do so. And some of you might think, gosh, 5.5%, that seems really high for a rental. I'll share with you that I still have some rental properties that the interest rates are above 5%, but they're loans that I've had for more than about 10 years, and they're on such low balances, under 100,000, that it's hard to justify the cost to get a refinance done. So understand the rates that you'll be looking at, and understand there's going to be a difference between owner-occupied property versus investor property. And that delta used to always hang out about 1 point difference in rate. But as we've seen the rates get driven down so low on owner-occupied properties, we're seeing that spread to be a little bit bigger up to investment properties, maybe as much as 1.25 or even 1.5 being the difference between investor rates and owner-occupied rates. When you're considering the mortgage rate that you're going to get as a part of a refinance, it's really important to understand the costs that go with that. I was speaking with a really great friend of mine recently who does a ton of mortgages, one of the top lenders in the state. And he was sharing with me what people were willing to pay to get to a better rate. Now, in today's mortgage environment, following Dodd-Frank, mortgage lenders typically get paid the same amount on each loan. They don't get a percentage or a higher commission for talking you into going to a lower rate and paying some points to get there. And he was sharing with me some stories where people were willing to pay 3 and 4 points in origination, really just to target a rate. They really wanted to get to 2.5% or whatever it might have been. We find ourselves so married to the rate that we'll pay anything to get there. And when people have equity in their homes, it's not costing them anything out of pocket to get to said rate. They're really excited about getting to that rate, but what they're missing is the cost that it actually took to get them there, and drastically increasing a payback period. So if you're looking at doing a refinance, just make sure it's going to be a good fit for you, your future, and your objectives. Rates are important to consider, but we also have to look at term. And this is where I think a lot of people get tripped up in a refinance and how much money they're quote unquote saving. The reason I say that is because so often you hear that radio commercial that talks about somebody who saved $700 a month, or your neighbor or a friend on Facebook is posting how they saved $1,200 a month on their mortgage by refinancing. It's really important to discuss what saving means. Now, when you refinance, you're going to typically, 2 things are going to change: your rate and your term. Unless you're taking cash out, then of course your mortgage balance would change, and you're typically not going to save money in that scenario unless you had a really high rate, you were able to bring it down and pull a little bit of cash out. But let's talk about the savings for just a minute. So the savings is going to come from 2 places when you do a refinance. Part of it's going to come in the rate. Let's say, for example, you had a rate that was at 4.5%, and you were going to refinance and get a rate down to 3%. So that's a pretty significant savings, 1.5 points in interest rate. In that scenario, about a 30% difference in the interest rate. So you're going to get some savings there. But where most of the time the biggest amount of, and I'm going to say savings again, comes from is the reamortization of the loan. So if you're in a loan that you've had for 5 or 6 years, and you've had a little bit of pay down, and you're going to get a better rate, and now when you refinance, you're going to basically re-amortize that loan over another 30 years, that's where most of the savings comes from, and the payment reduction, because you're taking a lower loan amount and now spreading it over a longer time period at a lower rate. So be careful when you're looking at the math on this thing. And of course, everybody's situation is different. If in your world, saving $700 a month now in your payment would be really advantageous to you, maybe you've had some challenges with COVID, or you've got some expenses coming up that you want to handle, then maybe you should do that. But you have to keep in mind that the likelihood is that your term is going to be extended by another 30 years and pushing out the opportunity to have that property paid out even a little further. Same would be true with investment properties. If you needed to eke a little bit more cash flow out of that deal, it might make sense to refinance it. When I look at my own portfolio and I've got loans that are 10 years old, I just can't see doing a refinance to increase the cash flow and restart that calculator at 30 years. You don't have to do a new loan at a 30-year term. A lot of these lenders are advertising make your own term. So if you're 10 years in, you could go to a 20-year loan. If you're 15 years in, you could go to a 15-year loan. You could decide what works best for you. And maybe in that case, you're going to capture some savings in rate by not completely re-amortizing the loan. But that's a really important to understand when people say that they're saving money on a refinance. When you look at the savings that are created through a refinance, oftentimes the next conversation is going to be your break-even period. And when somebody says a break-even period, this is important to understand as well. The reason is because you're going to take the total cost to get the loan done. And just for the sake of conversation, let's say that's $3,000 plus a point on the loan amount. So if you had a $400,000 loan that you're refinancing, that would cost you roughly $7,000, maybe a little bit more. And let's say that your savings from that was going to be, we'll do simple math, $350 a month. Well, that would tell you that would take you 20 months or just under 2 years to break even on the cost of your refinance. The break even point is good to look at because it gives you kind of an idea of the return you're getting on your investment. It's also important to look at because you need to understand how long you're going to be in the house. Let's say I moved to my house 3 years ago. So let's say I was looking at a refinance today and I was punching in the calculator earlier what a refinance would look like. And I was coming up with about 28 to 30 month break even period. So I've been in my house for 3 years. And if my break even period is going to be roughly another 3 years, and typically people move every 5 to 7 years, understand if that break-even period is going to fall in the time period when you might move. Now, a lot of things could change in 3 years. I don't intend on moving, but schools change, jobs change, family changes. So maybe you're unsure, but if you know that you're going to be moving out of that house in the relative near future, then maybe you don't do a refinance where the break-even period is going to be so far out. One thing to consider if you are looking at doing a refinance is the additional cost that's going to happen on federally backed loans, Freddie, Fannie, FHA, starting now December. It was going to start at the beginning of September. It's going to be a half-point fee paid to the government association backing the loan. So if you were going to refinance a $400,000 property, it's going to cost you another $2,000 to get that loan done, or about another quarter in rate. So if you are considering a refinance, it'd behoove you to get that done now before that half-point fee comes in. Now, we don't know if it'll actually make it in December or not. There's a lot of arguments about why it should or shouldn't come in, and maybe there'll be a battle through Congress, and maybe some of it will have to do with who's elected. But important that fee is coming down the pike. And so if you're considering the refinance, you should look at getting it done before that, just to save on some costs. Another strategy to consider when looking at refinancing properties is there's a lot of fixed costs when you're going to refinance a property. You have appraisals, you have title fees, you have processing fees for the lender. And so one thing that I've looked at in the past, because as I mentioned previously, I have a handful of these small balance loans, is instead of refinancing each of the properties to get to a better rate, refinance one or two of them and pull out enough cash to then pay off the third property. So you're increasing the balance on, say, one or two properties and using the cash out to pay off a third property. That way you're only paying the fixed fees once or twice rather than 3 times on all the properties, and effectively accomplishing the same thing by getting to a lower rate or a better rate on the outstanding mortgage balances. So that's one thing you might consider if you've got a portfolio of properties. Then it gives you a free and clear property that if you wanted to go and leverage it with a line of credit or something like that to have a little bit of capital available, you'd be able to draw a bigger amount there. So just really depends on your time horizon and your investment objectives, but there's an opportunity to save some costs on doing refinances and effectively accomplish the same thing. Here at Pine Financial Group, we consider ourselves financing experts. So if you're looking at considering refinancing some properties or having a little trouble putting the math together, we'd welcome you to give us a call or shoot us an email and see if we can help you there. We have great resources for lenders who can help with refinances, both traditional Fannie, Freddie, and bank financing in the markets that we lend in. So if we could be a referral or a resource for you there, we'd love the opportunity to help you. Thanks for joining me today. Remember, Pine Financial Group has all your hard money needs. fix and flip, buy, fix, refinance, or the BRRRR strategy. We also are funding some new construction as well as commercial value add properties. We'd love the opportunity to look at any project you're working on, so please give us a call, 303-835-4445, or check us out at pinefinancialgroup.com. Thanks.